Assalamu alaikum friends, welcome to SBR revision series for September 2021, and today we are going to cover presentation of financial statements IAS 1. So let's start the topics. Statement of financial position, profit and loss and other comprehensive income, disclosure notes, accounting concepts to apply in preparation of financial statements. So today's topic is about presentation. How do you present in the statement of financial position the assets, the liabilities, the equity, and in profit and loss and other comprehensive income, how do you present the expenses, right, the income, and in the disclosure notes also. So this covers the disclosure notes as well. How do you present under the disclosure notes, and what do you need to disclose? Accounting concepts to apply in preparation of financial statements. There are some accounting concepts that you need to apply while preparing the statement of financial position, statement of profit and loss account. So let's start. Statement of financial position. Okay, so assets and liabilities must be classified as current or non-current. You do not put all assets or liabilities in one category. They need to be separated out. A current asset is an asset that has the following features. Number one, it will be realized or consumed during the entity's normal trading cycle, and that normal trading cycle is usually within 12 months. Or is held for trading. It should be something which is held for trading. Or, you see, it's or. So any one of it is satisfied, then it's known as a current asset, or it will be realized within 12 months of the reporting date. So one example is your inventory. Inventory is held for trading, right? You held inventory to sell, and inventory normally you sell within 12 months, and it will be realized or consumed during the normal trading cycle, which is 12 months. Then a current liability. A current liability has the same feature as asset, just that this is a liability now. So that means it will be settled now. Okay, settled during normal trading cycle, held for trading, and will be settled within 12 months. One example is your interest on the loan, right? Normally interest you pay annually. Definitely that interest is for long-term loan, so that long-term loan is a non-current liability, because that you will be repaying the principal amount after 4 years, 5 years, depending on the amount of timing of the loan. But the interest you are paying annually. Okay, so that's why it is a current liability. There are so many examples of current liability. Your trade payables is one example of current liability, right? Now let us go to the profit and loss and other comprehensive income. So for statement of financial position, you only have to know the liability and assets, that they are into current and non-current. Come into the statement of profit and loss and other comprehensive income. We know profit is the primary source of information regarding the financial performance. Okay, so and OCI are expenses, income and expenses that are in accordance with IFRS standard are recognized outside of profit and loss. Okay, according to specific IFRS standard, if anything is recognized outside of profit and loss, where does it go? OCI. Mainly, most of the income and expenses are recognized in profit and loss, but only few exceptions are there. Few things goes to OCI. So out of those few things, one is what, when you remeasure to fair value. Earlier, you were recognizing a non-current asset at a under cost model. Now you have shifted to fair value model, so you have to revalue. So for that revaluation, it can go up also, it can go down also. You might be having a gain or a loss, so that revaluation gain or loss is recognized under OCI, not profit and loss. Okay, so these are some examples. Items of OCI. When you're presenting anything under OCI also, there are two categories. You have to present it either as items that might be reclassified to profit and loss in the future. There are chances that sometimes whatever you recognize in OCI later will come under profit and loss account in the future, but in the future, not currently. Sometimes it cannot be reclassified at all. That means it will forever stay in OCI only. There are some items like that also. Okay, what are these items that will be reclassified? What are the items that will not be reclassified? Are there in your specific standard? So as I cover the standard, okay, I will be telling you from time to time, these are the items that will be reclassified, these are the items that will not be reclassified. Okay, you have to know that list. Now, disclosure notes. Remember, it includes disclosure notes also, because you might be thinking presentation of financial statement means only all financial statements. No, disclosure notes also is a part of a financial statement. It also comes there. So this disclosure notes are the one that supplement the primary financial statement. This supplements it. This gives more useful information which is not covered in your financial statement. So it's like a supplementary. See, without having the financial statements, having a good disclosure note is of no use. It's not useful. You should have first the primary financial statements, yes, but over and all, you have to have your disclosure notes also. Disclosure notes are necessary. You cannot say I have primary financial statements are presented in a correct way, appropriate way, and I don't need disclosure notes. No, you have to. You need disclosure notes. And disclosure notes also don't think you are free to disclose the way you want. There are some guidelines there also how you have to present. So it includes information like accounting policies. You have to include your accounting policies. For example, for uh, which accounting policy are you using for measuring your assets, non-current assets, fair value, cost value, which one? Sources of uncertainty. If there are any sources of uncertainty, you have to write it in your disclosure notes. Remember, sources of uncertainty and all you are not recognizing in the financial statement. This you will recognize under disclosure notes. Valuation and estimation technique, depreciation. How are you estimating depreciation? How are you valuing it? Needs to be there in your disclosure notes. Unrecognized items, anything that is not recognized does not go in the financial statements. But if anything is unrecognized, it will be there in your disclosure notes. One is contingent liabilities. Yes, we do not recognize contingent liabilities, but we write it under disclosure notes. Even after the reporting period, your IAS 10, IAS 10. Disclosure notes should be ordered systematically. Remember that, not in any order. So what does it mean? It means displaying the most relevant issues prominently. Okay, most relevant issues first, least relevant issues later. Grouping similar items together. If items are similar, group them together and present. Don't write it separately. Following the order in which items are presented in the primary financial statements. Yes. How do you start your profit and loss account? You start with sales. So anything relating to sales will be disclosed first under your disclosure notes. In your statement of financial position, you start with non-current asset, land, property, plant, and equipment. So in your disclosure notes also, you will be starting in that order only. That order has to be consistent so that it becomes easier for the users also to know, okay, in the first few lines, I will be getting information about non-current asset. In the last line, I will be getting information about NCI, equity, retained earnings, because it comes at the end, no, in your statement of financial position. So when you are disclosing also, you have to keep these things in mind. Most important things first, similar items grouped together, aggregate and show, and has to be in the same order in your financial statements. Then we are coming towards the end. Accounting concepts that you have to apply while preparing the financial statements. Number one is going concern. So when we prepare financial statements, we always assume that it's going to continue, right? This business is continue forever. We don't think that okay, tomorrow this business is going to shut down. That's why we prepare financial statements or financial statements also on a 12-month basis, assuming that it will continue for the next year. Yes, there are some situations like that where you might think that you have to liquidate your business. You are not a going concern. Then you cannot prepare your financial statements using on a going concern basis. You have to prepare your financial statements on a breakup basis. What is the meaning of breakup basis? Up to the date. Up to the date when you are assuming that there will be going concern. When there are facts that has come to you, then now you know that this business is not going to survive anymore. Then you cannot prepare on a 12-month basis. Maybe you're going to prepare for 3 months, 8 months, depending, Then we have accrual concept. This is mostly for your income and expenses that you recognize in profit and loss on accrual basis. Then we have consistency. Consistently you have to do. If you have adopted one method, for example, depreciation, you are using on a straight line basis. Every year you will be using on a straight line basis. Unless you think it's no more relevant now, then you change. But changes in accounting policies are very rare. It should not be very frequent. So it has to be consistent so that you can compare easily. Because remember, one of the enhancing characteristics of useful information is what you should be able to compare according to conceptual framework. That's why it has to be consistent. The information, the way you present has to be consistent. Okay. Materiality and aggregation, you have to keep this in mind when you're preparing. If they are material items, have to be disclosed separately, have to be shown separately, even on the face of the financial statements. One example is IFRS 16 leases. Lease liability are normally shown separate from the other liabilities. Why? Because it is considered that it's a material item. And aggregation. If it's not material, if it's immaterial, you can aggregate them together. Offsetting. Are you able to set your assets with liabilities? Right? So we prepare using an offsetting basis. Okay. Wherever you can offset, you offset, and then you show the net result. But wherever you can't, for example, assets and liabilities, you cannot offset them together. You have to show them separately. Assets for assets, liabilities for liabilities. Because if you are showing it as a net result, after deducting that liability, you are showing the net result, net asset. Then you don't know how much of liability is there in that current asset. You understanding? It's hidden there. So wherever the law allows you, wherever it is allowed, you offset, but most of the time you don't offset. Okay, while you're presented under separate categories only. Comparability. Yes, you should be able to compare from this year to previous year, from with your competitors in the same line of business. So that's it. We are coming next with IAS 2, which is inventory. So very short video, right? Mostly we are going to talk about the measurement basis. How do you measure inventory? That's it. So thank you for watching and see you in the next video.